about the FOMC meet. In a few hours from now, we will be hearing from Jerome Powell and seeing what is expected from him. The consensus largely is that the taper program, that is the easing up of the Federal Reserve's bond buying program, could be accelerated. So instead of reducing by about $15 billion a month, they could double it to $30 billion a month. They could even advance the time by which they complete this program and start raising interest rates from June of next year to as early as March. So the words that come out of Mr. Powell's mouth will be watched very keenly tonight all across the world, because it's been impacting the way not just US markets, global markets, Indian equity markets are moving. It's impacting gold, bond yields, and a host of other factors. It's also going to tell us whether the Federal Reserve is going to weigh sticky inflation, and we'll see what they're going to be calling this kind of inflation, more than the fears of Omicron, or is it going to be vice versa? So before we get to the discussion on what's to be expected, let me take it across to my colleague Shrishti, who's giving us more context.
Yes, absolutely. That's a very important meet with eyes world over, and this time the expectation is building around that Fed could likely be accelerating the quantitative easing tapering, and all eyes will be on the commentary regarding this one, where the expectation is now building around that there could be $30 billion of reduction for January and further $30 billion of reduction in February 2022, and this would mean that Fed would be wrapping up their quantitative easing by March beginning. Now, if we see the Fed balance sheet, then that is likely to be left at $8.8 trillion of assets. That is more than double to its pre-pandemic levels of January 2020. And these steps that are expected to be taken paves the way for earlier and swifter interest rates hike. And as per the Fed dot plot, that is set to point a minimum of 2 moves in 2022. Now, if we see the setup of US economy, so the economy is definitely growing very strongly, but inflation pressures continue to build in, where in the month of November, we saw the consumer inflation coming in at 6.8%. Now, as per some of the comments coming in from the chair of Federal Reserve, that is Jerome Powell, he also pointed out that swifter policy normalization is already required. So let's see what are the actual steps taken in that direction. So all eyes on the FOMC outcome.
All right, Hugh Albert Johnson and Ajay Bagga join us on the show to talk about what we can expect. Hugh, why don't you begin with what you are looking out for?
No, I think you've got it right, that your expectation is that, of course, the Federal Reserve is going to accelerate the tapering process. That is, they're going to probably double the tapering process and expect to finish the tapering process, or the buying of treasuries and mortgage-backed securities, by, let's say, March of 2022. I think they'll take a hiatus at that point for just a couple of months maybe, and then they'll start to raise interest rates. So the focus of myself and everybody else is going to be, what is the Federal Reserve going to do when they finish tapering? They're going to raise interest rates in the second half of 2022. I would put it at one increase in the starting in the third quarter of 2022, but clearly the consensus is that they're going to raise interest rates 2 times in 2022, or that's what's being reflected in the financial markets in the US for the time being. So I think you've essentially got it right. I think that's what we're expecting. And the only thing you can do is hold on to your seats, because there may be a surprise. Let's not forget that economic conditions in the US are not quite as good as they should be for the increase in interest rates, and particularly the employment situation. So they may choose not to be as specific as I'm simply suggesting now.
So, Ajay Bagga, it's turning into a bit of a suspense this time round, isn't it? The question about whether the Federal Reserve will continue to support growth, the question about whether Omicron will weigh down. What are you reading between the tea leaves?
Yeah, Tamanna, definitely. This is the 4th big turn of Powell's, chairmanship of the Fed. In November, and in the Senate hearing, he's already called the inflation non-transient. And he said last time around that we will accelerate the taper. So he's communicated well, but this is the 4th big turn. What we are expecting today is the taper going up to $30 billion. The dot plot will be very keenly watched. The third, what does it show? The markets are more hawkish than the Fed, I believe. Markets are taking in a May interest rate hike, and on the back of March taper being completed, the markets are looking at 2 to 3 hikes in 2022 and 3 hikes in 2023 with a peak rate of 2.5%. So if any of those are exceeded in the dot plot, that will be hawkish for stocks and you could see a minor sell-off. Otherwise, it's largely discounted in the prices. The challenge for the Fed will be, what does it do with the monetization that it has done of the last 1.5 years, where it has grown its balance sheet very high to $8.8 trillion. How does it run off that balance sheet? Some of the senior voting members of this FOMC committee, like Bullard, have been saying that you should allow this balance sheet to slowly run off so that we have more ammunition. Let's see what he says on that. Omicron will remain an issue. So probably in the press meet at 2:30 p.m. New York time, he will say that don't go only by the dot plot of the interest rate hikes, but we will be watchful. In terms of employment, already we are at 4.2%, and in certain cohorts, especially in the older people, we are seeing whoever wants to work is employed. In the younger people, we are still seeing some unemployment. Inflation, both consumer and wholesale, has really beaten 30, 40-year records. So the pressure is immense. Even the political pressure is huge for moving fast. So overall, we expect faster taper, some communication on the interest rates, some communication on the GDP growth for next year. The challenge is today the consumer numbers from the US didn't come out as per expectations. The retail sales grew lesser than anticipated in the Thanksgiving month. So overall, there are a few challenges. Why is it important? It's important for all of us because it's virtually the central bank of the world. The dollar rate determines the flows into emerging markets. There's a very strong negative correlation. The stronger the dollar, the weaker the growth stocks in emerging markets get. So a very important day overall, Tamanna.
So, Mr. Bagga, just to follow up there, because you've already seen FIIs selling aggressively $4 billion in the last 3 months. Do you expect that trend to continue since people are betting and discounting for the worst, as you have said?
The markets tend to front-end the moves. So I think a lot of the moves have happened. Secondly, India really outperformed this year. At one point, we were 26% up year to date. Now we are in the 20% range. So there was some profit booking also happening regularly. I would say a large part of it has got front-ended. Second, a huge part of these outflows in the secondary market have been coming back in the primary market because we have had record fundraisers in the IPO market. Third, we are getting a lot of support from the private equity money. Nearly about $30 billion has come into Indian private equity markets this year. The foreign direct investments are quite huge. Plus the foreign FX reserves are very big at $640 billion. It's nearly about 1.3 to 1.4 years of import cover is now there. And that's true for most Asian economies. So not so much to worry in terms of FI outflows. I think it will be hurtful to the US economy to let the dollar appreciate too much. Last year, Tamanna, this time around, everybody was short the dollar and there were commentaries again pointing to the demise of the dollar. The market surprised us. This year, going into the new year, the longs on the dollar are very strong, as happens when there is a rate tightening happening. But I think the Fed will use other instruments like running off the balance sheet, for example, taking out liquidity rather than hiking the rates straight away and risking a very strong dollar, which will hurt the US economy. And given that even in the corporate earnings, a huge portion of US corporate earnings comes in non-dollar denomination. So it's not that simple. And I think the Fed will use all the nuances in its arsenal. But inflation remains an issue. It's not transient, but I don't think it's very largely permanent. We are expecting this time next year, the inflation to have come down to 3.5% to 4%, still very high on historical terms, but nothing like the 6.8 or the 9.8 of the producer prices that we are seeing right now.
Hugh, what is your take on the fallout since a hawkish stance is widely expected? How do you think markets will react and impact on emerging markets?
If there's any surprise that's coming, I think the surprise will be particularly from the dot plot, and it'll indicate if you take the dot plot seriously, and you really shouldn't take it that seriously, I think it'll indicate to some extent that the outcome is not going to be quite as hawkish as everybody is expecting. When we talk about 2 increases in the federal funds rate in 2022, the second half of 2022, and in some cases, the market's discounting 3 increases in the second half of 2022, I think that's too aggressive. I don't know how the markets start to size this up, but I think that that's too aggressive, and I think we'll be talking about 1, maybe 2 increases. Let's keep in mind that this is not only about inflation, and I think as was mentioned by your other guest, which is quite right, that the rate of inflation is going to be coming down by the middle of 2022. So when the Federal Reserve gets around to making decisions on interest rates in the second half of 2022, the US economy is going to be softer than it is now, and the rate of inflation will be lower. And therefore, I think they're unlikely to be quite as aggressive. Where the markets have got to figure that out. And if they do figure it out, I don't think you're going to be talking about as much an increase in interest rates as we've been previously expecting. That, to me, is not particularly good news for the dollar, but we'll have to wait and see. I think it's positive news for the markets overall. If they're too aggressive, 3 increases in 2022, 3 or 4 increases in 2023, that's particularly bad news for the US stock market. If that's what's in the cards, or that's what we read when we look at all that we hear today, then I think we're talking about real problems for the markets going forward in 2022-23. But I don't think sober-minded investors are going to reach that conclusion. That's simply too aggressive, and that's not consistent with the kinds of economic and inflation numbers we're going to be looking at in the middle of 2022. So I remain modestly positive on the US equity markets and very concerned that the dot plot and Chairman Powell are going to be a little bit too aggressive in what they say today. I don't think they're going to be, but that's always a possibility.
All right, we'll know in a few hours from now. Thank you so much, Hugh Johnson and Ajay Bagga, for joining us and sort of setting the stage for what is going to be a very important announcement in just a short while from now. Thank you.